The most alarming economic signal is flashing red, and it's moving faster than anyone expected. I'll show you what you need to know. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the most dangerous economic signal just hit new highs, and it's the clearest warning yet of what's to come. And at the end of the month, we're going to hear from the Federal Reserve, who's going to say the economy is on solid footing and doesn't need any more rate cuts. But as you're about to see, that's the furthest from the truth. But before we get to that, with sales on the decline, retailers are closing doors across the nation. Is this the start of a retail apocalypse or just a smart financial move? Plus, there's a strange twist in the economy. I'll show you what's really going on. Now let's head over to Macys, where we picked today's story up with a headline, as Macys confirms planned store closures, and this is a huge problem for the economy because at a time we're seeing more people hit the unemployment line, what we need is jobs, and we need them now. And yet, due to rising inflation and slowing wage growth, consumer spending has slumped, demand has dropped, and in response, companies have cut costs in every possible way. And we've been warning that the next thing that they would do is start to shut down their unprofitable lines, and we're seeing that now. This plan is designed to return the company to sustainable, profitable sales growth, which includes closing approximately 150 unproductive stores over the next 3-year period, while investing in its 350 go-forward Macys location through the end of next year. And one of the issues we're facing is already rising unemployment, and now we're seeing companies closing stores. It means more Americans are going to hit the unemployment line, and even worse, the opportunity for them to re-enter the workforce is not going to be there. And closing any store is never easy, but as part of our bold new chapter strategy, we're closing underproductive Macys stores to allow us to focus our resources and prioritize investments on our go-forward stores where customers are responding positively to better product offerings. And we're going to see more companies like Macys closing stores, closing locations, because in boom times, there's always going to be unproductive lines of a business, where for it's a retailer, it's going to be a store, it could be a product line, could be anything. And yet what you see is due to the profitable lines, due to the expanding economy, companies will keep these unprofitable locations running in the hopes that they turn around. But when the economy slows, they can no longer afford that. And what we're seeing now is Macys and many other retailers facing the ultimate decision, and that's putting more Americans on the unemployment line. And Kohl's announced the closure of San Bernardino e-commerce fulfillment center in May and the closure of 27 underperforming stores by April of 2025. And think about this. If the economy was indeed turning around and booming, Kohl's would keep that fulfillment center open. But they note due to technological changes and enhancements, they don't need it anymore. And they don't need those 27 stores. And all that means is more people are going to be out of work. And when we look at what's going on with Macys, you see there's going to be no opportunity to re-enter the workforce. But those aren't the only companies. We even see REI joining the list, as when they look at the all-up cost of running a business, which includes costs like marketing and technology, we're losing millions of dollars every year in subsidizing experiences with profits from other part of the business. And last month, party retailer Party City announced filing of Chapter 11 bankruptcy, shuttering almost 700 stores nationwide after being in business for almost 4 decades. The company said it faced an immensely challenging environment driven by inflationary pressures on costs and consumer spending, among other factors. But that's something we're hearing from every company right now, that prices are too high and consumers are not responding. They don't have the income growth. They don't have the confidence in the economy because the labor market is starting to unwind. And what this is doing is putting strain on household finances. When that happens, people cut back spending, and next thing you know, other people are losing their jobs. And more than 40% this year said they changed their financial priorities over the previous year. And among those whose priorities have shifted, 27% report covering daily living expenses such as groceries and utilities is a priority that has changed the most. And this is something I've been saying was absolutely going to happen. As prices go up, consumers realize they can't afford all the discretionary spend they used to, so they cut back. They start focusing on the essentials, the staples, rent, food, and energy. And that means no more money for experiences, as REI is saying. And for companies like Macys and Kohl's, it means store closures. In fact, TD Bank revealed that 30% of respondents had reduced their spending, citing concerns over the economy despite inflation slowing down. And the issue is inflation isn't slowing down fast enough because wage growth is also declining. We saw that on Friday in the non-farm payroll report, that hours worked for the rank and file employee was virtually stagnant, but at the same time, employees employers said, look, we're not going to pay you as much. And what this is doing is putting pressure on household finances. But if you're looking for a way to turn yours around, well, check this out. Here's the big trade that we have on right now. This is a trade that I'm all in on. I told our subscribers they need to be on it. It's not too late. I think this is going to go up another 5, 6, maybe even 7%. And as of Friday's close, it jumped and jumped big. Here you can see for our CTA Timer Pro and our Momentum Timer Pro subscribers, both up over 4% on this trade. Some saying they got emails saying, look, Steve, I just paid for your reports for years now. Thank you. Now, what do we do every day? We look at machine positioning and we look at discrepancies on where a stock is trading and the machines are at. And we want to position our subscribers to buy before the machines do, to put a tailwind behind them and get out before they do. We do that every day. We give you the signals. We give you all the notes. Now, maybe you like to trade those momentum signals, but you get in late and then you get out early and you're all over the place. Well, we smooth that out with a proprietary indicator. We call that our Momentum Timer Pro report. Every day you get the reports, you get the signals, you get my opinions. You can even follow along exactly with what I'm trading. We fully back tested our reports. We give you risk control levels, a full update every week. And here's the best part. We're extending that 30-day free trial because I want you to make money. I want you to make money right alongside me. And it's just that simple. You can do it with your trading account. You can do it with your other accounts. Hit those links in the description below because right now my trading account is crushing the market. And you can too. Let's take a look at some of these charts and the effect of inflation on retail sales. As we turn to real retail sales, this is inflation adjusted in blue against the consumer price index in red, both shown on a year-over-year rate of change. And what we can see going back to the late 1990s, when inflation is rising, well, at first consumers can handle it. Then all of a sudden, consumers say, look, I can't afford that discretionary spend. My dollar's not going as far. And next thing you know, real retail sales declines. And they get that combination together of rising inflation and slowing retail sales, it puts you right into recession. You see that happen starting around 2006. Inflation now is moving higher. Real retail sales on the decline right into a global financial crisis. And how about now? Inflation has been coming down, but is still too high. In fact, over the last 3 years, real retail sales has largely been negative. And based on what we're seeing from this recent survey from TD, it says they're going to plunge here in the first part of the year. Because when it comes to spending, it's all about incomes. And now let's take a look at real retail sales versus total income growth as we look at average hourly earnings multiplied by average weekly hours. And what do we see? That when income growth slows down, real retail sales goes right with it. You can see it when we almost had a double dip recession coming out of the global financial crisis, and you can see the effects of it now. Income growth continues to slow and retail sales driven entirely by credit spending, but that's not going to last. So now let's take a look at these together as we now see total income growth against the consumer price index, and it makes perfect sense. Economic slowdowns occur when prices are rising and consumers can't afford them. You see that happen again right at the global financial crisis when we almost had that double dip recession. Remember around 2016, 2015, what did we see? The stock market slowed down, effects of inflation and slowing wage growth, and now you see the two running together. The issue here, inflation still running too hot. And now let's turn to our lead story today because U.S. corporate bankruptcy soared to a 14-year high as now the most alarming economic signal is flashing red with 61 filings in December alone. And here you can see, looking after the global financial crisis, filings were fairly consistent. After all the pandemic stimulus, as expected, they declined. And now look, we're facing the highest level in 14 years, all the way back to 2010. And businesses continue to face pressure in 2024 from elevated interest rates, especially as total debt among credit-rated non-financial U.S. companies reached a quarterly record of $8.45 trillion, and interest coverage remained weak in the third quarter of the year. While some relief came in September when the Fed began lowering its benchmark interest rate from a 20-year high, the central bank's monetary easing may slow this year. Well, in fact, despite the fact that the Fed cut rates, midterm and long-term interest rates did go higher, putting pressure on these companies who were hoping to refi at a lower rate. Well, it's not going to happen. So what we saw post-pandemic now during the last expansion is companies loaded up on debt. They have so much debt that they don't have enough revenue to support it. And now we're seeing delinquencies and bankruptcies rise. This is the biggest red flag for a debt-based economy you can get. And companies classified within the consumer discretionary and industrial sectors each accounted for 9 bankruptcies bankruptcy filings in December, the most out of the 11 sectors tracked. Those were a combined 199 filings with these two sectors in 2024 alone, accounting for 28%. So it makes sense. When we go back to last year, we saw the slowdown beginning. We saw that manufacturers noted that their backlogs were getting worked down, that their new order growth was slowing, and that leads to delinquencies, and delinquencies eventually lead to defaults and bankruptcies. And then we're seeing, of course, in the consumer discretionary space, because the two go right in hand. If we're not seeing spend in the consumer discretionary space, you don't need the manufacturing of those discretionary items, and all of a sudden we're seeing the economy slow down in a dangerous way. And in turn, commercial Chapter 11 filings increased 20% in the calendar year of 2024, and this is dangerous because it also means consumer filings are going up. And as anticipated, we saw a steady increase in bankruptcy filings throughout 2024 and expect that growth trend to continue in 2025. And we've warned that where delinquencies go, that you get defaults and bankruptcies. It was only a matter of time, because what is this telling us? There isn't enough money in the system to pay on all the debt. And that what happens exactly when you start restricting monetary policy, you start restricting the creation of credit. Next thing you know, too much debt, not enough money, and you're right smack into a crisis. If the current trend continues, new bankruptcy filings will return to pre-pandemic normalized volumes in the next 24 to 30 months. Modest rises in household debt and elevated delinquency rates reveal the stress households are experiencing and are reflected in the steady increased bankruptcy filing trends. So we come back to Macys, Kohl's, REI, and all these companies, Party City. What are they faced with? Consumers can't keep up with inflation. They took on too much debt, believing that the economy was going to turn around in their favor, and now they're finding out it's not. They cut their spending. And so what we saw with these companies like Macys and Kohl's, they're cutting stores now, but wait till they have to cut even more stores and more jobs. If you don't think it's coming, hang tight. Because when we look at retail sales versus delinquency rates, it makes perfect sense why we see slowdowns in retail sales, because when people go into delinquency, well, banks don't extend credit. So we go back to around 1994. What do we see? Delinquency rates in red rising, retail sales go flat. We see delinquency rates start to rise again in 1999 and retail sales plunge. How about we go back to 2006? We see the trend happen again. Delinquency rates on the rise, not enough money to support all the debt in the system. Retail sales take a hit right into a financial crisis. And now we're seeing the early signs of it, but with the bankruptcy data suggesting that more Americans are falling behind, more businesses are falling behind. And what we're seeing is not being reflected by what the Fed's going to tell us at the end of the month. It's not being reflected in the equity markets. What we're seeing is the foundations of a debt-based economy start to crack and fall apart. And now let's take a look at why it has everything to do with incomes as we come back to average hourly earnings multiplied by average weekly hours of production of non-supervisory employees, now shown in blue against the delinquency rate. And again, it's about jobs, it's about incomes. And when you see income growth slow, what happens? The delinquency rate goes up. It happens each and every time. And look at where we're at now as income growth peaked in 2022 as the pandemic stimulus went away. And as it's gone down, the delinquency rate has been rising. Wage growth has not been there. There have been enough jobs created or enough high-paying jobs for consumers to afford all the debt they took on. And what you're seeing is, again, the beginning stages of a massive unraveling. Many people say the Fed will never get back to zero. But if delinquencies keep turning into defaults and bankruptcies, you bet they're going to. Overall, consumer filing totals rose 14% over last year. Consumer Chapter 7 filings increased 19%. The continued increase in bankruptcies over the past year reflects the growing list of economic challenges faced by consumers and businesses. Rising interest rates, inflation, increasing geopolitical tensions, and shifts in post-pandemic consumer spending have more struggling businesses and families turning to bankruptcy for a fresh financial start from their growing debt loads. And remember, after the election, what happened? Everybody piled into banks saying that under President-elect Trump's second term, we're going to see a boom and the banks are going to be big beneficiaries. But remember, the banks are going to take the hit on this because when people can't pay on their debt and they get it discharged, the banks have to write it off. So what we're seeing here is, again, it's all coming back to the labor market. The expected boom in the economy didn't happen, and there's way too much debt. And when that happens, and debt bubbles burst, well, we already know. It's called a financial crisis. And we can see again coming back to the labor market when we look at continued unemployment claims against the delinquency rate. We can see when delinquency rates are rising, well, that means spending drops and more people hit the unemployment line. We can see that relationship started back in 1994, again in 2000, around 2006, and you can see it happening now. The only problem is the Fed thinks that everything's on solid ground. In fact, even consumers are optimistic, which is a strange twist, because what's coming is not going to be optimistic at all. As University of Michigan inflation expectations soared to the highest since 2008, and current conditions even surged in December. But it's what the future holds. It's not going to be optimistic. The data was mixed, with current conditions soaring further. This is likely due to the election outcome, while expectations dropped down to the lowest since July, as people realize that the election hope is starting to fade, that maybe the real economy is in far worse shape than anyone wants to realize. And we look at slowing wage growth, when we look at continued unemployment claims, we look at delinquency rates and bankruptcies, what do we see? It's an economy headed squarely into a recession. And as far as inflation concerns, well, consumers have that wrong, because U.S. regular all formations gas prices continues to head lower, and that really is a proxy for inflation expectations. So while we saw an uptick in the data, that's not likely to last. But as far as the optimism in the consumer sentiment data, it's not going to hold either, because optimism has everything to do with the labor market. When you have a job and things are going well, you're optimistic. But if you lose your job, well, your optimism is going to plunge. And sure enough, that's exactly what we see heading into every recession. You see continued unemployment claims on the rise. And what happens? Sentiment. It stays elevated at first, and then it comes plunging down. You see it happen again around 2001, again in 2009, and you see the beginning stages of it now. And sentiment is rising right alongside continued unemployment claims, but that's not going to last, which is exactly why we're seeing future expectations start to turn lower, because in a debt-based economy, the biggest alarm, the biggest red flag is rising delinquencies, rising defaults, and rising bankruptcies. When you get that combination, at some point, you find yourself right in the middle of a financial crisis. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.